Instead of using preferred returns, you can use the IRR form of hurdle structure to do it. So let me explain what an hurdle means. Literally, it means when you hit a particular target, the terms change. You hit on that particular target, the terms change, so that we don't get to the point where we get agitated and say, this deal is not worth it. We introduce preferred return when that deal has significant amount of cash flow. It's not for every deal. For people like that, if you are the one that likes appreciation so much, you should be looking for very big IRR. But if you are someone that likes cash flow, you should be looking for 6% upwards cash flow. In this case, it's structured as an IRR. That is, when you get to a particular hurdle, it changes. So for example, I started my deal as a 70-30 split with the LP. The GP, Reggie is the LP. Reggie, you're taking 70, I'm taking 30. Now, this is how I'm going to structure it. I would say, once I get to an IRR of 15%, that hurdle now becomes maybe 60-40. Once I'm able again to improve the property and I'm able to get it to maybe an 18% IRR, the order now moves to 50-50. So we structured two deals like that recently, that once it performs well, we will no longer be at 70-30 splits with the investor. We'll have to adjust the order to accommodate our effort. What this does is that it promotes performance from the GP. So incentivize the GP to perform more so that they can easily adjust the order for it to favor them. This is another way you can structure a deal in form of hurdle. We have that on a deal. That deal, this is how it's structured. After we've paid the lender, we do a cash on cash. Then we said we're going to refinance in 3 years. On the third year, if we're able to refinance and we're able to give the investor, I think 18% or 20% IRR, let's assume we get to that in 3 years, it becomes a 50-50 split because we've hit that hurdle. So you can actually structure a deal. Instead of using preferred returns, you can use the IRR form of hurdle structure to do it. So let me explain what an hurdle means. Literally, it means when you hit a particular target, the terms change. You hit on that particular target, the terms change and all that. Please note that this must be included in your PPM, in your agreement with the investors. You can't just wake up one morning and say, oh, I've given them everything that they owe. I told them I was going to give them and now I'm going to switch it. No, you have to have those agreements in your PPM at the beginning, that once you get to a particular hurdle, we will switch. Once we get to a particular hurdle, the split will switch. This normally will incentivize the GP more to perform more and do more for the deal. There's another one again. It's called the IRR-based waterfall. In this way, this is the example. 100% goes to the LP until they hit 8% IRR. Then at 80-20 split until 12% IRR. Then 70-30 split above 12%. It's more like what I just explained to you as well. In this case, the investors will get 8%. Once we get to 8% IRR, 100% of the money goes to them. So let me explain. I'm going to still use my 500,000 profit that I've made. So let's assume my 500,000 is equal to 8%. What I promised you was 8%. In quote, let's say that translates to 500,000. The entire money, I'm going to give it to the limited partners. But if I'm able to make that 500,000 become 700,000, you can see it has moved from 500,000 to 700, and that 700,000 translates to, let's say, 12%. The split now becomes 80-20. I will give the investor 80% and I'll take 20%. And if it's 12% above, let's say I make 1 million, at that point, it now becomes 70-30 split. So there are different ways for you to structure a deal and for you to also understand at what point do I get the large chunk of money. Like I explained to you guys, bulk of the money does not come at the beginning. It comes at the point of sale when there's a cash event or a capital event. That is when bulk of the money comes. What you're receiving before that capital event happens, literally, I will call it interest. It means that you put your money down, and while the money is performing or working for you, you are getting some form of interest on it. It's just like you putting the money in the bank, like I said, and you put your money in the bank, most times it's 1% you get. Why would you want to put your money in the bank and get 1% rather than putting it on a deal and maybe getting a 7% on it, cash on cash or preferred returns and all that? Why would you want to do that? So when you see $1,000 or 750,000 in your account, don't assume that that is what this entire deal is all about. That is just a portion of what your returns looks like. Like we normally say, there are 3 ways you can make money money in real estate. In short, 4 ways. One is the cash flow, which is this preferred returns and the cash on cash we just mentioned. The second one is through tax benefits. That is, while you are still holding on to the deal, you can depreciate the asset. Either you do it because normally residential properties are 27.5 years. You can do that long cut of depreciating it every year little by little, or you go the route of doing the bonus depreciation where you expedite most of the assets to depreciate them within 1 year, and you take that entire fund and write off your tax. So there's a caveat on that. It is unique to the individual. How are you a real estate professional? Do you have a W-2? How's your family structure? So many things goes into it. But the bottom line is these things in form of K1s or this tax benefit can be used, but you need to talk to your CPA to understand how you can effectively use it. That is one. The third one is if I decide to refinance a deal, that is a cash event that can return maybe 50% or 100% of the investor's money. So let's say, for example, at the beginning we raised $4 million, and in 3 years this property has appreciated and has done well, and I decide to refinance and I'm able to pull out 3.5 million. That means in 3 years I can give back the investors from the 4 million. I can give them 3.5 million and still have 500,000 in the deal. Then maybe I run it again for another 3 years and sell. When I sell, I make maybe an additional 2 million. Again, I take that 2 million and I still give it back to the investors at the end of the sale. That is how money is made, and that is how you build generational wealth. Now, some people will take that money and go and spend it and do whatever they want to do with it. But some will still take that money and roll it over into another deal, and that deal keeps multiplying. And what they literally will depend on is the cash flow. So for us, that's what we've been doing. We roll over our sales amount, we roll it over, and it starts compounding. But what we don't joke with is our cash flow. We take that one and we spend it as if our life depends on it. We do not roll that one over and all that. So when I get a deal at the first time and I see there's a green light, because most of the answers are not at the early stage, most of the answers will come along the way. But what we try to do is once there's a solid green, like very solid green, that is, move ahead with this deal, is a good deal. What we do is, let's say we underwrite the deal and the deal is giving us a 10% cash on cash. We will never tell an investor it's 10%. Never. We'll give you a 7 or a 6%. And why are we doing that? Because we understand that during the period where we are under contract, before we close, many things will move. The more the information we get, the information we gather, is either the deal becomes better or it becomes worse. Now, maybe at the beginning we said we're going to go ahead with it. It's a solid green. Let's go ahead with it. During the due diligence part, two things will happen. Either we go forward or we go backward. If the deal now did not perform as much as we wanted, let's say, for example, after we've gotten a lot of information and we went back to check on the writing, instead of the 10%, it now becomes 8%. It still shows us that it's still a good deal. We are still at the threshold of what we told our investors. Remember, we communicated 7 or 6% to the investor, but while we were under contract, maybe due to some discrepancies from the seller or from interest rate or the leverage we got from the lender, all those things can make a deal change or even become bad. That's how we're able to navigate it around. Let me give you an example. Last year, we were under contract for a deal. The loan amount was 11.7. By the time we closed, it was 11.180 million. That can break a deal significantly. The good thing that we did was that we did a lot of case study on this deal, and we did a worst case scenario. That what if the market changes? At the time we were underwriting this deal before we closed, what would happen? We adjusted our underwriting to ensure that when those changes happen, we can accommodate it. So when those things happen, we adjusted our numbers, but it did not get below what we had earlier communicated to the investors at the beginning. So that is one way. When you're underwriting, you don't communicate your last number. Be conservative and communicate a lower number to the investor. So that is one. The second one is, when do I know that I want to introduce a preferred returns or a cash flow? When I see the DSCR is high. So what is a DSCR? It's a debt coverage ratio. What that means literally is that after you've paid your lender, what is the cash flow left? If that cash flow is somewhere around 1.4, it gives me a signal that I could actually introduce preferred returns on this deal because it has significant cash flow on it. But when that deal is struggling to be at 1.25 or 1.3, that is a signal to just leave it as cash on cash. That is my own standard. Other people can do it differently. But for me, if the deal has a lot of cash flow, then I can play around with the number because I'm like, okay, worst case scenario, this deal is going to make cash flow, but we'll be able to deliver to the investors and all that. And most times what we also do to protect ourselves as GPs, we invest our money, so that we don't get to the point where we get agitated and say, this deal is not worth it. We introduce preferred return when that deal has significant amount of cash flow. It's not for every deal. When a deal does not really have cash flow, I leave it as cash on cash, literally, and all that. Just make it simple, cash on cash, and everybody is happy. You get your returns and everyone is happy. Another one, when do I introduce hurdle? When do I know that I need to introduce hurdle on a deal? When I see a potential of a deal. So when I look at a deal and say, in 3 years, this deal will become magical, meaning that in 3 years, we would have improved on this and this deal will be superb. I don't think we should sell this deal. I think we will be able to hold it longer. But if we're going to hold it longer and satisfy the investors, I don't think at 70-30 split will be good for us, because we've done a lot of work to ensure that, one, we met our promise to the investor, and two, we've improved on the property very much. In that case, that is when I sit down and say, this deal, no, we have to put hurdle on it, so that at the point, because I know we will be able to meet the hurdle. Once we're able to meet it, next, we'll split it. It's not going to be 70-30, it becomes 50-50. But let me also explain something to you. We could also structure a deal that once we meet the hurdle, we can buy out the investor. You have that option to do that I told you 17%, and come 3 years, I'm able to fulfill it. In 3 years, I'm buying you out. I'll give you whatever it is I told you, and that's it. I own the deal going forward. We've seen sponsors doing that. They buy out their investors when they've made or fulfilled their promise, they buy them out. But why we don't do it on our deals is because we want a long-term relationship. We want a repeat investor, because getting one investor is hard. So when you have one, you have to, protect it and ensure that you are doing right by them. So that is why that's the incentive for us, because at the point whereby we're giving you everything we said, why should we leave you? There's an investor that asked you what's the catch? You've given me everything I want, and you still want me to be on the deal. What's the catch? So those are things we look at. If a deal has a long-term potential, we introduce a hurdle. But if a deal, we know that this is like almost a flip, we don't do flips. When I mean flip, I mean in 5 years we are selling, we are done. There are some deals that we have for 10 years. There are some deals that is 7 years, but we know that in our mind, that deal will reach 15 years or more. Right now it's 7 years, but once we get to 7 years, we will assess the market and say, okay, should we keep going? We'll do that. So deals like that, we put those hurdles. But deals like 5 years deal that we know this one is just go in and get out, take the money in and sell off. We don't put any hurdle in it. We are going to sell and everybody will be happy. You still come with us on the next deal and all that. So for you as an investor, if you're a limited investor, you need to look at what suits you. Some investors, they like cash flow. Some will tell you, I want the appreciation. That's what I'm looking for. I'm not looking for cash on cash. It's too small for me. I'm looking for the large chunk of money. Some will say, I want both. I'm in that category. I like both, So you just need to know which you prefer. Do you want to put your money in a deal and be getting some little stipends from it before the real cash comes in? That's your decision to make. Or do you want to put your money in a deal and you don't really care if any little money comes in? You just want the big one. That's for you. So once you're able to determine that is the type of deal you should go for. So for people like that, if you are the one that likes appreciation so much, you should be looking for very big IRR. Very, very 25% IRR, 22%, very big IRR. That's your target. That's what you should be looking for. But if you are someone that likes cash flow, you should be looking for 6% upwards cash flow. That's what you want. And at the same time, you should be looking for between 16% IRR and above if you want both. So let's say I want both for a deal. If that deal does not meet like a 6% cash on cash, I won't invest in it. Or if the deal does not meet a 16% IRR, I will invest in it. So that is for someone that wants both. But if you're someone that do not care about cash on cash, so let me say someone brings a deal to you and it's 2% cash on cash, but the IRR is 25%, 22%, and it's like a 3x multiple. That means you're going to get triple the money you've invested. Let's say you invested 50,000, you're going to get 150,000 at the end of the hold period. If that is you, then that's the type of deal you should be looking for. 3x, 2.5x, 3.5x. Those are the type of deals you should be going for. So everybody here is different. I'm okay with 2x, right? But I want my cash flow constant. That's what, even if it's small, it can help me pay some utility bills, so pay for some children's stuff. Tariff has gone off. I can use it to pay some tariff, high product, I need it, So yeah. So if you're in that category like me, those are things you should look out for.